Hedge. Anything you want.
Andrew Maguire, gold market set to spike violently higher, crushing hedge fund shorts today. London whistleblower and metals trader Andrew Maguire told KWN that hedge funds are about to be crushed on their massive gold short positions as the price of gold spikes higher. Gold price spike is coming. Andrew Maguire, Eric, bear in mind that insiders had the NFP, non-farm payrolls, data by Monday, and, accordingly, spent the week profitably positioning for today's official release. But as the NFP dust settles, a strong bullish reaction in all the crosses related to gold is being observed. The surgically timed, surprise, Chinese margin increase from 0% to 20% rinsed and dislodged a large percentage of leveraged specu on shorts. The raising of reserve requirement for FX forwards to 20% is gold bullish, and indeed evidenced an immediate bullish gold reaction in the correlated CNY/gold cross. Given that the house, CME Insiders, is heavily long against lured and record naked gold short specs in the COMEX run casino, the house always wins, and that means a huge move higher and the gold price is now upon us. The open interest structure along with the OPEX footprints are evidencing commercials pricing in higher gold prices further out on the curve. Sentiment is in the tank, so expect rallies in the gold market to continue being shorted. But all the necessary components are in place to suggest a bottom is now firmly in place. A pit close above $1,235 would affirm this. Short interest has been foreshadowing a move higher for days. China on track to log record year for gold imports. While on the subject of China, as we have been observing, flying in the face of all the bearish World Gold Council gold demand estimates, China is on track to log in a record year for gold imports. How has it been doing this? By playing the insiders at their own game, using leveraged paper gold to spot index gold prices and to buy physical with an equally devalued yuan. Since May we have noted Swiss refinery backlogs, which accelerated after Trump's mid-June trade war escalations. So contrary to reports of gold being out of favor, it is in massive demand, although this fact is completely masked by sucked-in specs chasing bearish chart patterns that have zero to do with a strong physical market. Hedge funds to get crushed on gold shorts as a result of discounted physical gold with little on offer, other than producers forced to accept the bid price and to rig PM fixes. The physical market is so tight that the legacy market is forced to fractionalize and pull allocated gold. This is increasingly evident by refusals to deliver clients allocated gold, something we have been providing details on in recent KWN interviews. So that's why it is the second half of this year that is going to blow people's minds when it comes to the gold price taking off violently to the upside. Meaning, the hedge funds are going to get crushed on their gold shorts. The failure to deliver excuses have ranged from Swiss and German capital controls limiting cash and cash equivalent withdrawals to €100,000, gold being categorized as cash, to outright demands to cash settle clients. These are clients whose banks have dared to charge full allocated storage fees for what amounts to fractionally held, unallocated pooled accounts. These recent refusals to deliver telegraph a disconnect between strong physical demand and an unprecedented record naked short, synthetic, undeliverable structure which has expanded to such extremes that it has spilled over into the legacy conduit. There is no argument from industry apologists that unallocated gold is leveraged at roughly 100 ounces of paper claims for each 1 ounce of vaulted physical. However, it was never envisaged that there would be a sudden series of physical delivery requests to withdraw gold in physical form. But this is exactly what is happening, and we are doing our utmost to get as many allocated account holders to at least inquire about taking physical delivery. This has resulted in a slew of refusals. We have drawn attention to 2 major failures in KWN interviews, and we will be following up on further developments very soon. In the meantime, make sure that you have your physical gold in your possession. Is the gold market finally set up to break the gold ceiling? With many investors nervous about the currency carnage in emerging markets, is it a setup to break the gold ceiling? Given the setup, from both the positioning standpoint and the action in the miners, the rally ought to continue for quite a while and go a long way, although the metals will remain volatile and try to trick as many people as possible. Nonetheless, this is the best chance we've had to see all the magic trend lines above the market, that is, $1,350 to $1,370, finally get taken out. But, as they say in AA, one day at a time. The Dow and S&P lost between 0.75% and 1% early on, while the Nasdaq barely flinched. The proximate cause for the decline appeared to be weakness in Europe, which of course is emanating at this moment in time from Italy, as once again the concept of the European Union is being threatened. However, I suspect it was really just time for the rally to roll over and this was the excuse. How far the problems in Italy undermine the entire EU we will have to see, but that is almost a sideshow because the real problem is that once central bankers turn to ZERP, NERP, and C, they can really never leave that regime, at least not willingly. Markets can force higher interest rates, as we've seen in countries such as Argentina, Turkey, Greece, etc., but people say that can't happen in a G7 country, to which I would say, oh, yeah? However, so many people in the US have been inured to any bad news due to the anesthetization caused by 8 years of critical analysis hardly exists anymore, although macro-oriented problems revolving around massive amounts of debt continue to escalate. Turning back to the action, in the afternoon the Nasdaq finally joined the slide to some degree, as it lost about 0.5%, while the other two major indices fell 1.3% to 1.5%. Away from stocks, green paper was stronger against most everything except the yen, oil lost 1.5%, and the bond market went wild. For everyone who feared the 10-year cracking 3% would certainly cause huge trouble, this is a lesson in what can happen in crowded trades. The metals were all over the place, higher last night than weaker early in New York before they rallied some, with silver losing 0.4% as gold gained $3. Included below are 2 questions and answers from the Q&As with Bill Fleckenstein. PZN Silver Bill, how much impact do you see to PZ by its cutting back operations at its Mexico mine? Pre-market May 29, 2018 hit is 5% decline in stock price. You are always very cautious about mine locations, so was this occurrence risk a surprise to you or was it built into your position? Thanks for your help. Answer from Fleck. Mexico isn't as safe as it once was, but it is still better than many other places. But, no, I didn't expect this trouble near the Dolores mine, although I had heard about it in the middle of last week. I am sort of surprised the reaction has been as big as it has. I doubt this will be a problem for too long. You may recall we saw the same sort of reaction to the brief strike at Haran about 6 weeks ago. An overreaction. All of us prefer miners in safe jurisdictions. I'm sure you'll be besieged with questions on this topic, but is Mexico no longer a safe place? A work interruption staged by an aggressive union is one thing, but when the rails and highways are unsafe, and the government is on unfriendly terms with its primary trading partner. Answer from Fleck, Mexico isn't as safe as it used to be, but that for sure isn't new news. I am not sure what you mean when you say and the government is on unfriendly terms with its primary trader partner. If you are referring to Trump and Mexico, that has little to do with this current issue at the Dolores mine. This is likely to be a transitory problem. The company feels that the government will make sure that the mine, and other businesses, can function,